Hi everyone, welcome back to Corporate Decoder, the place where we unpack the secrets behind big companies and their financial reports. And let me tell you, LSEB Korea Corp's latest filing is going to be a wild ride. Buckle up. We're diving into LSEB Creative Corp's annual report, which basically tells you everything that happened with the company over the past year. Think of it as a yearly checkup and a look at how the business is doing. So LSEB Creative Corp, what do they do, you ask? Well, they're a specialty retailer and their big focus is on men's and women's swimwear. They're aiming for that high-end luxury market with products that are supposed to be top-notch in quality and style. They even have a unique approach of offering gender-coordinating collections so couples can match. Pretty neat, or maybe a little much, we'll see. Now, before we get into the nitty-gritty, it's important to know that LSEB Creative Corp trades on a smaller market called OTC markets. Under the ticker symbol LSEB, this often means less trading activity and potentially more price swings compared to major exchanges like the NYSE or NASDAQ. And here's a big one right off the bat. They admit they have a limited operating history and no real brand recognition. That's a major hurdle for any new company, especially in a competitive market like fashion. It means they have to work extra hard to get noticed and build trust with customers. This is probably the most crucial piece of information in the entire report. Their own auditors are saying there's a real question about whether the company can even keep operating in the future. This usually means the company isn't making enough money, is burning through cash too quickly, and doesn't have a solid plan to become profitable. It's a huge red flag. Let's look at the financials. For the year ending March 31, 2025, LSEB Creative Corp generated 20,537 awards in sales. Now compare that to the year before, ending March 31, 24, where they only made $3,989. So they did see a jump in sales, which is good. But when you start from such a low number, even a small increase can look significant. It's like going from selling one swimsuit a month to selling two better, but still not exactly setting the world on fire. And unfortunately, that low sales number translates directly into their bottom line. For the year ending March 31, 2011, the year before the loss was slightly higher at 163,553, 1,553, 1,553, 1,550, 3,553, 1,553. $1,553, so while sales are up a bit, they're still losing a significant amount of money. They are losing about $0.0 per share. Let's peek at their balance sheet. This gives us a snapshot of what the company owns and what it owes. As of March 31, 2025, their cash balance was a mere $888. Seriously, less than $1,000 in the bank. This is incredibly low and directly ties back to that going concern warning from the auditors. It means they have very little buffer if anything unexpected happens or if they need to make a crucial investment to grow. They have $184,461 worth of inventory. This is actually a pretty significant chunk of their total assets, and it has increased quite a bit from the previous year's $129,992. While having inventory is necessary for a retailer, a big jump like this when sales are still in the very low thousands could mean they are holding on to more stock than they can sell, or it might indicate they're preparing for future growth, which they'll need financing for. Their total current liabilities, which are debts due within a year, are $156,265. A big part of this is $116,596 in advances from a related party. This basically means people close to the company, likely the founders or major investors, have lent them money to keep the lights on. This is not uncommon for startups, but it highlights their dependence on these internal sources as they haven't secured external funding on a large scale. On the equity side, they have about 1,638 are listed for common stock. This seems small, but it's based on the par value, which is the nominal value assigned to shares. The real story is in the additional paid-in capital, which is $752,402. This usually comes from selling shares above par value. It shows they've managed to raise some capital by selling stock, even if they are now losing money. And then there's the accumulated deficit of $714.45. This is simply the total of all their past losses. It's like a running tally of how much money the company has lost since it started. Seeing this number grow year after year, as it has here, reinforces that going concern problem. Looking at their cash flow statement, the net cash used in operating activities for the year ended March 31, 2025 was a negative 152,716. This confirms that their day-to-day business operations are consuming cash rather than generating it. On the other hand, they had positive cash flow from financing activities, 146 thus for the year. This money came from issuing stock and those related party advances we talked about. It shows that to keep operating, they are relying heavily on external funding, not on sales from their core business. This section is dedicated to that big red flag we saw earlier. They basically reiterate that because of their ongoing losses and low cash, there's substantial doubt about their ability to continue operating. They are pinning their hopes on raising more money very soon. And in the notes to the financials, they call out again their dependence on financing. They're actively looking for a minimum of $400,000, possibly up to $1 million, through private placements or convertible debentures. They believe this will help them avoid that going concern issue. They even mention a bolder plan to raise $5 million for a Nasdaq uplist, which shows they have ambitious growth plans, but the immediate concern is much more fundamental: survival. Now, jumping to controls and procedures, they highlight a few material weaknesses. This essentially means their internal systems for managing money and reporting are not as strong as they should be. Key issues include a lack of proper segregation of duties, no independent board oversight, and not enough clear documentation on how things should be done. For a public company, especially one hoping to get on Nasdaq, having strong internal controls is super important for building investor confidence. Let's talk about the leadership. Lauren Bentley is the CEO and founder. She's young, 28, and has been involved in many aspects of the fashion business. Jordan Starkman, at 55, is the CFO and a director, bringing over 30 years of experience in sales and financial consulting. It's a classic setup with a visionary founder and an experienced financial partner. Interestingly, they report stock-based compensation, meaning they've issued stock awards for services. Lauren Bentley received $7,321 in consulting fees, and Jordan Starkman received $0 in consulting fees in 2025. They also mention each received founder shares at inception, which is common for early-stage companies. Looking at who owns the company, Lauren Bentley owns about 34.2% of the shares, and Jordan Starkman owns about 15.3%. Together, they hold over 49% of the company, meaning they have controlling interest. This isn't unusual, but it means their vision and decisions are really what drive the company forward. And as we saw in the financials, they have significant related party transactions. This includes advances from their officers, meaning the founders are injecting cash, and consulting fees paid to Lauren Bentley. These are normal for startups, but it highlights their reliance on insiders. Their auditors, Aloba, Omolo and Partners, charge $8,000 in audit fees for the year ending March 31, 2025. This is a relatively small amount, which is typical for companies at this stage. Finally, the report includes certifications from the CEO and CFO, confirming the accuracy of the financial statements and various XBRL documents required for electronic filing. So what's my take on LSEB Creator Corp? Looking at the numbers and the disclosures here, it's clear this is a very early stage company with a lot of potential challenges. The extremely low cash balance, the substantial operating losses, and the auditor's warning about their ability to continue operating paint a picture of a business that is highly dependent on future financing. While they are seeing some sales growth and have a clear vision for a luxury swimwear brand, they have a long way to go to become a stable, profitable business. The lack of strong internal controls and director independence also presents risks. However, they are actively seen quickly in a crowded market and effectively manage their operations and financial controls. And director independence also presents risks. However, they are actively seeking capital and have ambitious plans to grow and potentially even list on Nasdaq. It's a high-risk, potentially high-reward situation. Their success will hinge on their ability to attract significant investment, build brand recognition quickly in a crowded market, and effectively manage their operations and financial controls. Alright, that's our breakdown of LSEB Creative Corp's latest annual report. What do you think about their chances of success? Do you see potential in their luxury swimwear concept, or are the financial risks too great? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up, and make sure you're subscribed for more deep dives into corporate filings and for even more exclusive content, and to connect with other finance enthusiasts, join our Discord community. The link is in the description. Thanks for watching, and I'll see you in the next one.